regular Friday summary of the news. This week, our guest is Kamal Warwick of Canaccord Genuity Wealth Management. He's responsible for picking funds for that team, well, for suggesting them. So it's going to be quite interesting to hear what he has to say about what their view of the market is, I think. Couple of bits of news that I pulled out, again, when we're into the summer and things are getting relatively quiet, but JLEN Environmental Assets and Fundsmith Emerging Equity. The first one of those, JLEN announced its June NAV this week, and it was pretty good. So 123.1p, which is up 7.8p since the 1st of March. There's various things contributing to that, but as we know, it's a combination of much higher power prices, which gradually feed through into the NAV because a lot of the power sales it does have been done on long-term fixes. So those only sort of feed through once those things roll off. There are obviously assumptions built into the model for the NAV in terms of where the power prices are, and that changes things too. And they've made some other revisions to long-term forecasts that might include higher inflation, I should think. That's probably going to be quite a big one. We won't know exactly what they are until they publish more information. I think that's going to come out fairly soon, but we'll wait and see. The dividend is running at 7.14p for the year, paying quarterly. So that's all good. Everything seems to be on track and the NAV is going in the right direction. Here it is on the chart, which is a 5-year one, and you can see how strong the NAV has been recently, and the share price has been responding to that. So actually, that rating is not very high relative to where it has been. I mean, if you look at the sort of average of here, we're probably about sort of 5 or 6% short of where we should be. So I think, barring anything else, the share price is probably going to carry on trending up, which is what I wrote in the news story yesterday. It's made 2 new investments this week as well. So one of these is a battery storage facility. It's got a 50% stake, and I think part of the interesting thing here, it's bought it as a sort of half and half thing with Foresight Solar Fund, which the 2 funds are now managed by the same management house, although not by the same team. And they do have different remits, obviously, but there are some places where they overlap, and where they do, it makes sense for them to share things like this. So they're spending £14 million over an extended period to get this thing built. It's a normal kind of lithium-ion battery storage plant. It's linked into the sort of hydroelectric grid up in Scotland. Everything should be ready to go, as it says there. And it's already got the grid connection in place. At least that was my reading of the news announcement. And that's quite an important thing to have ready to go, because that has been a constraint on some people getting things live. But actually, we're not talking about it being operational until the end of 2024 in any case. But nevertheless, so that's a commitment that's made. Once it's been built and running, then realistically, these things tend to add to the NAV because without the construction risk involved, they're worth a bit more money. So that's good news. The other thing is something brand new for the fund and for the sector, really. So they're investing in a trout farm, which this is always a bit different. UCAN is where the Heroes of Hallmark thing was done, where the Nazis were making heavy water. But now it's just a lot of very nice clean water in locks and stuff. And they are trying to find ways of developing their economy. Part of what they've been doing is green energy to fund various bits and pieces, but to fuel various bits and pieces. But also, this is a relatively new idea. If you think about salmon farming and what a sort of bad press that's got, probably for good reasons. One of the ideas about putting it on land is that you can control the environment completely. But obviously, shifting something like that on land is an expensive process. So what we're talking about here is JLEN putting up £40 million out of the total spend that I've read. JLEN didn't say this, but I've read it somewhere else. So about €250 million. That's to get everything in place. There are other Foresight funds investing in this, and also the developer operator, Hema Seafood, is going to be putting money in too. And the plan is to produce about 8,000 tonnes of trout a year, so starting in 2024 and full production in 2025. There are bigger plants already under construction than this, so they're not completely pioneering this whole idea. This is what the facility is supposed to look like. This is obviously a computer mock-up, and with the roof taken off, so you can see what's going on underneath it. So it's a massive, great thing. So 320-meter long building, over 27,000 square meters, but spread over 2 levels. And sort of water comes in at one end, and the fish are going in the tanks, and everything sort of comes out the other end. But critically, the water is treated, so before it's returned to the environment. So because you completely control the environment, you've got much less risk of any kind of contamination coming in terms of like lice and that sort of stuff. And because you haven't got that problem, you don't have to use as many chemicals and antibiotics and things to prevent disease. And you don't get the risk of contaminating the environment for wild stock either, which is obviously great news. So big ticks there in terms of its environmental credentials. It's also using excess heat from a data center up the road, which is powered by green energy. So data centers chuck out huge amounts of heat. That's being transferred through the hot water through a pipe to this thing. The heat's used then to help run the whole fish farm, and then they return cold water back to the facility. So the whole thing's in a complete sort of cycle. So as I say, it ticks lots of boxes for me. I think it could be quite an interesting thing, and whether they can find more of these sort of things to do or not, we'll wait and see. We're going to have to wait to hear from JLEN what exactly the economic effects are, how actually monetize that, and what the risk is in terms of, are they exposed to the risk of whether you can sell the trout or not. But they arguing in their announcement there's this huge demand, which is probably incontrovertible in terms of like the demand for fish and protein generally. So I think they probably will do okay. So good news. Then something not quite so good, Fundsmith Emerging Equities. It's been around now since 2014, so it's had quite a long time to prove itself or not. And I think you could probably argue that it has not proved itself. There was a huge retail following for the beginning, lots of enthusiastic investors. I think they've had the stuffing knocked out of them a bit, and that enthusiasm's waned quite a lot, as you can see there from the discount. So that's widened out considerably over the past year or so. And in terms of the NAV, well, in terms of most people who put their money in at 10 quid, they really paid virtually nothing now over the whole life of the fund. Although the NAV's gone up, but the discount's widened. So it's £309 million. It's a decent size. The discount today is about 14.4%, which is one of the widest in the peer group. As I say, it's been underperforming its benchmark from the beginning, really. Here's some numbers here. So this is taken from the end July fact sheet. And you can see there that from inception, the NAV is up 36%, the share price up 16%, but the MSCI Emerging Frontier Index, which is the benchmark, is up 60, so it's way behind. And part of that, I thought it'd be interesting. It's always had quite a big bias to India, so just comparing it to Indian funds, because you might say, well, that's kind of the Indian exposure. No, if it was just a standalone Indian fund, it would be the worst performing one over 1 year to 3 years. Not brilliant over 5 years either. And definitely in share price terms, not great. So it's not the Indian exposure that's done it. The reason people liked it is it's following the normal kind of Terry Smith approach, so relatively concentrated portfolio, simple to understand companies, not relying on making high ticket sales of high ticket items, not a lot of trading, so to find things, stocks you like and stick with them, quite a strong sector bias, so no financials, which are obviously doing well at the moment because interest rates are going up. No cyclicals, which probably would be a good idea in this kind of environment, but that means largely things like no mining and stuff like that as well, which has been doing a bit better. No utilities, no transport. So basically what you're really left with is largely consumer stocks. And then there's the other big sort of Terry Smith thing is this emphasis on cash generation, cash return on capital. And to achieve that in a sustainable manner, you need defensible, strong market positions. It's essentially a growth-focused fund, and obviously that's not been helpful recently, but then all of those emerging market stocks are really. And it doesn't pay an awful lot of income. So that's one reason why investors, maybe would not be interested in chasing it. There's the big India bias I was talking about. So 45%, 46% of the fund. That US exposure includes a thing called Mercado Libre, which is Uruguayan, Argentinian internet company. I don't know what else is in there because it doesn't give you its full list of holdings very often. If it's just Mercado Libre, that's quite a big bet now. One of the other things it doesn't do in its fact sheets is tell you how big its top 10 holdings are. So we just don't know. But obviously the other thing that you take from this is it's very low weighting in China. And that's, again, makes it sort of slightly unusual. And there you've got the big weighting to consumer that we were talking about before. So there it is against the sector. And obviously, we're not supposed to be trading at a much wider discount than the sector average. I think you could ignore Africa Opportunity. That's a very sort of weird and wonderful fund. Even BMO is not really a sort of global emerging fund because it's a regional thing. So if you knock those two out, then the only one that's widened there is Utilico Emerging Markets. And so it really is towards the bottom end of this peer group. So I think that argument, something ought to be done with it. They haven't bought any shares back since the 13th September 2021, and I don't think there's any good argument why they haven't done that, given the market cap is 300 million, and you can definitely argue that you don't have to worry too much about liquidity. And given the NAV uplift that you would have got from buying back stock at a sort of 14-15 discount and cancelling it, it just, to me, they are sort of letting the side down here a bit. But what the board said, and it depends probably where you put the emphasis on this, it's sceptical about whether this policy alone will serve to close a discount. To me, that sounds like a very heavy hint that the board are thinking about what to do to sort the discount out. Whether that means tender offers or performance-triggered continuation votes or a combination of things like that, I don't know. But I think if you are a Fundsmith emerging shareholder, I think maybe you should be writing to the board demanding that they sort of get on to doing something. Because I think the situation that's been allowed to persist is not really tenable for the long term. And that's triggered loads of questions. So what we got? Do you think we need a new manager? I don't know if we're there yet. I mean, it very much, this was bought by people on the back of it being a Terry Smith style fund. So I'm not sure a new manager is necessarily give the answer, but it's an option. Is it a lost cause? Honestly, we don't know, because I think there obviously are circumstances where this style would work, and it does work or has worked for the much larger fund. It is interesting that in emerging markets it hasn't really worked at all, and I do wonder if they're being too prescriptive about the sort of funds that they're buying. Part of this idea about capturing the growth of consumer society in emerging markets, you can do it through consumer stocks. You can also do it by investing in banks. That's one of the things that the old Jeffy manager was quite keen on doing. And then, to me, they're missing the trick by not investing in financials. And as to why they haven't bought new shares, I'd like to think that the manager's not influenced that decision. It's not a Terry Smith ego thing. So, but there is no good reason why they haven't bought bank stock. Would you buy country funds instead? There aren't enough country funds to replicate the whole of the global emerging market index. You can obviously buy China funds, India funds, but yeah, it's a tricky thing. I like the idea of having a good asset allocator working for me in these sort of situations, and so therefore I probably prefer to buy a global fund. That is that. Okay, now